If you are a new investor, you probably began with stocks. Now that you have a little more experience, you might want to branch out and add to your portfolio. Diversifying your portfolio has been shown to be the best way to reduce risk and make the most money. As an investor, spreading out your assets protects you from changes in the market, which is becoming more and more important in the modern world. Investing in commodities is a good way to diversify your portfolio beyond traditional securities. But if you're a new investor, it's important to learn to trade commodities. Hello everyone and welcome to Success Wisdom. In this video, we're going to talk about Learn to Trade Commodities Beginner's Guide. If you're new to this channel, do like and subscribe to the channel. Commodities are basic goods that are all the same and have the same use. This includes everything from the grains in your breakfast cereal to the silver and copper in the crude oil that is refined into the gasoline you use in your car. Commodities can be many different things, but they all have one thing in common. They are all real things that people buy and sell on markets all over the world. The prices of goods can change a lot when supply and demand change. For example, the price of a crop usually goes down when there is a big harvest, and it usually goes up when there is a drought because people worry that the supply will go down. Metals that are traded are usually put into four main categories: energy, livestock, and meat. Each type of investment has its own pros and cons, so you should choose where to put your money based on what you want to get out of it in the long run. Investing in commodities can be risky if you don't know what you're doing. In the long run, it will be much more helpful to learn the basics before moving on. There are many ways to learn to trade commodities, and each one has its own pros and cons. Here are 6 ways to get started trading in commodities. First, put your money directly into the commodity. If you want to invest by buying a physical good, there is no other way to trade commodities than by buying one of them directly. You don't have to go through a third party, which is a benefit. You can just look for a dealer who sells a certain item. When you no longer want it, the dealer will usually buy it back, but you have to figure out how to get it back to them and where to store it. Also, if you're buying gold, this transaction may be a bit easier. On the internet, it's easy to find a coin dealer who will sell you a bar coin. You can store it safely and sell it whenever you want, but it's much harder to figure out how to deliver and store bushels of corn or crude oil. Because of this, most physical commodities are too hard for individual investors to buy because it takes too much work. Second, buy commodity exchange traded funds or ETFs. If you know how to invest in stocks well but don't have much money to invest in, it's best to invest in commodities through ETFs. ETFs are exchange-traded funds that let you buy and sell commodities like stocks and shares. They can be bought and sold like stocks, and their prices change as the day goes on. Investors who want to buy commodity ETFs or exchange-traded funds can do so with the help of a traditional or online broker. ETFs are a great choice for people who are interested in how the prices of commodities change because they can potentially profit from price changes without having to invest directly in futures contracts. Trading ETFs is also a great way to get into the commodities market with less risk, since you can hold your ETF shares for as long as you want and they don't expire after a certain amount of time. Before you invest, you should know about some of the fees that come with trading ETFs, or you can just ask your broker if they offer demo ETF trading. Third, you should put your money into mutual funds and index funds. Mutual and index funds are good ways for investors to start investing in commodities because they work differently than other types of commodity investments. These funds are liquid like stocks, but unlike mutual funds, they don't trade on an exchange. Most of the time, a professional fund manager is there to help you when you invest in commodity mutual funds. Just remember that fees tend to be higher for managed funds. With a managed account, you can invest in many different goods and industries at once. This is called diversification. Index funds, on the other hand, follow the price of a certain commodity over the course of a trading day. Mutual funds don't use an exchange, so they don't keep up with the price throughout the day. They wait until the end of the day, when the price has been set, to figure out how much something is worth. By putting your money in these funds, you get professional money management, more diversification, and easy access to your money. This makes mutual funds and index funds great investments for people who want to make money from companies that deal with commodities but don't want to buy stocks directly. Before we continue to the next one, how to learn to trade commodities. If you like this video, don't forget to like and subscribe to the channel. Fourth, buy goods through commodity pools. Pools are a way for group investors to use their money together to buy future contracts and options. If you haven't invested in commodities before, these people collect money from many investors, put it in one fund, and then invest it in a commodity or basket of commodities. Investors will get statements of their accounts and annual financial reports. Your CPO will not only be in charge of managing your fund, but they will also keep track of who is investing, what they are investing in, and any other transactions that involve the pool. They may also make decisions about investments based on how the market is moving. For example, they can help you keep track of the prices of commodities and figure out which ones are best for your portfolio. When it comes to investing, you also have more options when you work with the CPO. Because they manage a group of investors, they can use the funds from all of them to make better investments, which gives them more chances to trade commodities. 5. Put your money into contracts for the future. A futures contract is another way to buy and sell commodities. A future contract is a legal agreement to buy or sell a certain good at a certain price at a certain time in the future. Futures contracts require a lot of research before you can start using them, so they are usually not a good choice for new investors. The reason for this is that a lot of investing in futures is based on guesswork. Investors can work with a broker or choose contracts that give them the option to buy. Traders bet on which way the price of a good will move with futures contracts. You would buy futures when you believe the price will rise and sell futures when you believe the price will fall. Usually, you agree to buy X amount of a certain good at a certain time in the future. For instance, you could agree to buy 10 tons of coffee 30 days after the trade is made. You're hoping that the price difference will be big enough by then for you to make a profit. One of the biggest risks of trading commodities is that the margin requirements are much lower than they are for trading stocks. When you trade on margin, you use money you don't own. This can make your losses bigger. Because commodity prices can change quickly, it's important to have money on hand to cover a margin call, which is when your broker asks you to deposit more money. The S&P 500 Index, the Dow Jones Industrial Average, the Nikkei 225, the FTSE 100 Index, and the DAX Performance Index are some of the most popular exchanges for futures. Sixth, you should buy commodity stocks. You can also invest in commodities in a roundabout way by putting your money into companies that make commodities. You could, for example, buy stocks in a mining company, oil stocks, or stocks in farms. You can get into the oil business by investing in British Petroleum, and you can get into all kinds of metals by investing in Rio Tinto. Most of the risks that come with commodity stocks are related to the companies themselves. For example, business operations or other company-related factors can have a negative effect on the prices of the companies themselves, not just the value of the commodities. This means that a company that makes a commodity won't always go up or down with the commodity it makes. A company that makes oil will make more money when the price of crude oil goes up and lose money when it goes down. But what's much more important is how much oil in the company has in its reserves and whether it has lucrative supply contracts with buyers who need a lot of oil. There is no way to completely eliminate this risk, but investors can do a lot of research on the companies before buying stocks. Okay, guys, here are the 6 ways you can put your money into different commodities. Even though commodities are known to be risky investments because they can be affected by things that are hard or impossible to predict, such as unusual weather patterns, epidemics, and both natural and man-made disasters, there are some commodities that are less risky than others. Overall, commodities are best for investors who have a lot of money and at least a little bit of experience. Rather than putting all your eggs in one basket, The best way to manage risk is to include commodities in a balanced portfolio. If you want to invest in a commodity for the long term, most people would be better off with commodity stocks, mutual funds, or ETFs. We've reached the end of another video and thank you for watching. I hope you understand and learn to trade commodities. If you like this video, do give us a like, subscribe to the channel, and comment down below. Thank you and goodbye.